Chapter 3, Introduction to Risk Management. We know that there are many methods to manage risk. For example, buying insurance. In this chapter, we will learn other methods to manage risk, and we will learn the whole risk management process. Let's first see the definition of risk management. Risk management means a process that identifies loss exposures faced by an organization and selects the most appropriate techniques for treating such exposures. And what does a loss exposure mean? A loss exposure means any situation or circumstance in which a loss is possible, regardless of whether a loss occurs. For example, if you are a business owner, you have a plant. Your plant may be damaged by an earthquake or by a flood. This is a loss exposure. Or if you have a car, your car may be damaged in a collision. Similarly, if you have a house, your house may be damaged in a fire. In other words, if you own more, you have more loss exposures. And how to do risk management? The risk management process contains 4 steps. The first step, identify loss exposures. You need to know what is your possible loss. And the second step, once we identify these loss exposures, we need to measure and analyze the loss exposures. After analyzing these loss exposures, we need to select the appropriate methods, appropriate techniques to treat these loss exposures. Later, we will discuss these techniques, such as avoidance, loss prevention, and loss reduction. And after that, the final step, we need to implement this risk management policy. And we need to monitor this risk management program regularly to see whether we need to make some changes. Let's see our first step. Identify the loss exposures. In a previous slide, we said that, well, if you own something, you may lose it. So it's a loss exposure. Actually, more than that, you may get fired unexpectedly. So the loss of earned income is a loss exposure. You may become disabled because of an illness or an accident. This is another loss exposure. In the previous chapter, we mentioned the longevity risk. So the insufficient income during retirement is another loss exposure. Undoubtedly, unexpected high health costs is a loss exposure. Identity theft and credit card fraud definitely is a loss exposure. Recently, identity theft becomes a serious problem. Let's see a case study. Capital One. Do you know this bank? Capital One is the 5th largest credit card issuer in the US. However, it announced in 2019 that a hacker accessed the personal information of around 106 million customers and applicants in the US and Canada. The hacker got information including customers' names, social security numbers, income, and date of birth. It's quite scary, right? Now the problem is, who is paying for credit card fraud? Fortunately, the average US consumer loss is about 429 from credit card fraud. In fact, 79% of customers who experienced credit card fraud didn't suffer any financial loss. So who suffers? Who is paying for this fraud if not the customer? The financial institutions, your banks. So as a customer, you are fine. However, if you work for a bank or a financial institution, you face more and more pressure. In 2015, global credit and debit card fraud resulted in losses totaling $21.8 billion. And the card issuers and merchants incurred 72% of losses. And the amount is about 16 billion. Okay, so the amount is quite huge. Go back to our lecture notes. Identify the loss exposures. Basically, the loss exposures can be divided into 3 groups. Okay, first group, personal loss exposures. As we mentioned earlier, loss of an income, insufficient income during retirement, and catastrophic medical bills are personal loss exposures. The second group, property loss exposures. Okay. Again, your car or your house may be damaged by a fire or by a flood. Finally, don't forget the liability loss exposures. You may drive carelessly. You are a negligent driver and you hit other person. You need to pay the related medical costs. Or if you have a dog, your dog bites other person, you also need to take responsibility. After we identify our loss exposures, we need to measure and analyze the loss exposures. You need to consider 2 things. The first one, loss frequency. We want to know whether the accident happens frequently. In other words, we want to know the proper number of losses that may occur during some time period. If it happens frequently, we need to pay more attention. You also need to consider loss severity. Loss severity means the possible loss amount, the proper size of the losses that may occur. If the possible loss amount is huge, of course, we need to pay more attention. We measure and analyze each loss exposure, and then we rank exposures by importance, which loss exposure may result in severe loss. Keep in mind, loss severity is more important than loss frequency. If an event is unlikely to occur, but if it occurs, it results in a huge loss, we need to pay more attention.